Hello everyone, and welcome back to the channel. Today, we are addressing a critical financial issue that directly impacts your hard-earned savings, retirement funds, and peace of mind. If you have ever deposited a large amount of cash, sold a vehicle, received a financial gift from your children, or moved your own life savings between financial institutions, there is a specific dollar amount that triggers an automatic federal report. Your bank will not ask for your permission, and they will not inform you when it happens. This report goes directly to a federal agency that most Americans have never even heard of. However, what is truly concerning is not the report itself. The real danger lies in what most retirees do when they discover this rule. The natural instinct to protect one's privacy and stay under the radar is the exact decision that can transform perfectly legal money into a federal criminal investigation. Last year alone, the federal government seized funds from thousands of citizens whose since was completely legitimate. My goal today is to ensure that you never experience this. To understand how to protect yourself, we must look at the legal foundation. Under the Bank Secrecy Act of 1970, every financial institution in the United States, including commercial banks, credit unions, and savings and loan associations, is required by law to file a currency transaction report, commonly known as a CTR. Anytime a customer conducts a cash transaction that exceeds $10,000, this report is automatically generated on FinCEN Form 104. It is sent directly to the Financial Crimes Enforcement Network, or FinCEN. It is crucial to note that FinCEN is a bureau inside the United States Department of the Treasury, not the Internal Revenue Service. Please understand that the bank files report, not you. You do not fill out a form, you do not sign any paperwork, and you will likely never know it occurred. The financial institution has 15 calendar days after the transaction to submit it electronically, and they are required by law to maintain records of this report for 5 years. This process occurs millions of times every single year across the country. The vast majority of these reports go absolutely nowhere. No federal agent will call you, no one will show up at your doorstep, and your account will not be frozen. A currency transaction report is not an accusation, it is not an audit, and it is not a red flag on your account. It is routine, automatic government paperwork. However, understanding this distinction is where many honest individuals unintentionally jeopardize their future. When people hear about the $10,000 rule for the first time, they often have a defensive reaction. They think that if $10,000 triggers a government report, they will simply deposit $9,000 instead. Or they decide to break the amount into smaller increments, spreading the deposits across a few days or weeks. This deliberate decision to stay below the reporting threshold has a specific legal name. It is called structuring. Under federal law, specifically Title 31 of the United States Code, Section 5024, structuring is a serious federal crime. It does not result in a warning letter or a simple fine, it carries severe criminal penalties. It is strictly illegal to structure any transaction with a financial institution for the purpose of evading these reporting requirements. You do not need to be laundering money, committing fraud, or engaged in any illegal activity. Even if the money is entirely clean, legally earned, inherited, or gifted, the moment you deliberately alter your transaction behavior to avoid the $10,000 threshold, you have committed a federal offense. The penalties are exceptionally harsh. For violations involving less than $100,000 within a 12-month period, the law permits a sentence of up to 5 years in federal prison and up to $250,000 in fines. For violations exceeding $100,000, the penalties escalate to up to 10 years in prison and $500,000 in fines. Furthermore, under civil asset forfeiture laws, the government can permanently seize the money involved. Let us look at the legal precedent. In 1994, the Supreme Court of the United States ruled in the landmark case Ratzlaff v. United States that to convict someone of structuring, the government must prove 2 distinct elements. First, that you had knowledge of the reporting requirement, and second, that you knew the act of structuring itself was illegal. While this provides a layer of legal protection, you must realize that by learning about this rule today, you now possess that knowledge. If you choose to break up a deposit to avoid the threshold tomorrow, a prosecutor will argue that your actions were intentional. An IRS study revealed that 91% of all structuring forfeitures involved legally sourced funds. These were not international criminals, They were ordinary citizens and retirees who mistakenly thought they were being clever. Beyond the CTR, there is a second, far more dangerous reporting mechanism known as a Suspicious Activity Report, or a SAR. Unlike the CTR, a Suspicious Activity Report has no minimum dollar threshold. A bank can file a SAR on a transaction of $500 or even $200 if they perceive the behavior as unusual. Banks utilize highly sophisticated pattern recognition software designed to flag individuals who are attempting to avoid detection. For example, depositing $9,000 on Monday, $8,000 on Wednesday, and $9,500 the following week will immediately trigger the algorithm. The system does not view these as separate, ordinary transactions. It identifies a clear pattern of evasion. What makes suspicious activity reports uniquely dangerous for retirees is that you will never be notified if one is filed against you. Federal law strictly prohibits bank employees from informing a customer that a SAR has been generated. Doing so is a crime for the bank employee. Therefore, your account could be flagged at this very moment, and you would remain entirely unaware. While CTRs are routine and systematic, SARs are targeted and investigative. The difference between triggering a routine report and a criminal investigation often comes down to a single decision regarding how you handle your cash. The most effective strategy to protect yourself is to stop trying to manage what the bank reports, and instead, focus on ensuring your documentation is flawless. Your paperwork is your ultimate shield. Let us analyze 5 common real-world scenarios where retirees frequently make critical mistakes. Scenario number 1 involves selling a vehicle. Suppose you sell your car privately for $14,000 in cash. This is entirely legal and normal. The mistake occurs when you decide to deposit $7,000 today and the remaining $7,000 next week to avoid the $10,000 line. That is the definition of structuring. Instead, you should deposit the entire $14,000 in a single transaction. Bring a copy of the bill of sale containing the buyer's name, your name, the date, the amount, and both signatures. If the teller inquires about the source of the funds, simply state that you sold your vehicle and present the documentation. A routine CTR will be filed, and your life continues without interruption. Scenario number 2 involves financial gifts from family members. Imagine your children give you $15,000 in cash for an anniversary or to assist with medical expenses. This is a gift, and under United States tax law, it is not considered taxable income for the recipient. However, well-meaning friends might advise you to split the money across different bank branches to keep it under $10,000. This advice is entirely incorrect and leads directly to a federal crime. In the year 2025 and continuing into 2026, an individual can give up to $19,000 per recipient per year without any reporting requirement whatsoever. Even if the gift exceeds this amount, the person giving the money files a gift tax return, not you. The recipient of a gift never owes taxes on that money. You should deposit the full amount immediately. Have your child draft a brief, 1-paragraph gift letter specifying the donor, the recipient, the amount, the date, and a statement confirming that the funds are a gift with no expectation of repayment. Keep this document filed safely. Scenario number 3 is moving your own savings, which is a situation that frequently causes unnecessary hardship. Consider a case involving a 69-year-old retired school teacher who was recently widowed. While grieving, she decided to consolidate her finances by closing an old account and moving $23,000 of her hard-earned life savings into her primary bank. To avoid dealing with a single large transfer during a difficult emotional period, she moved the money in small increments of a few $1,000s over several weeks. She had no criminal intent, yet the bank's automated software flagged the pattern and filed a suspicious activity report. Although she was eventually cleared of wrongdoing, the process required significant legal fees, months of severe anxiety, and immense emotional stress. This could have been avoided completely if she had transferred the full $23,000 in a single transaction, while maintaining the statements from both bank accounts as proof. Scenario number 4 involves inheritances. If a relative passes away and leaves you $40,000 from their estate, whether delivered via check or cash from a personal safe, there is no federal inheritance tax for the vast majority of Americans. The current federal estate tax exemption stands well over $13 million. Unless the estate was extraordinarily wealthy, you owe no taxes. However, if you deposit that cash in separate pieces over several weeks, the bank's system will flag it as structuring rather than an inheritance. The correct procedure is to deposit the entire sum at once and retain a copy of the will, the estate settlement letter, or the executor's official documentation. Scenario number 5 involves Social Security lump sum payments. If you delayed filing for benefits, you might receive a retroactive lump sum deposit that easily exceeds $10,000. When this money arrives, a CTR is automatically generated. Some retirees panic upon seeing such a large balance and immediately begin moving smaller portions of the money to various accounts. This sudden shifting of funds can inadvertently trigger a suspicious activity report. The best course of action is to leave the money alone. The Social Security Administration and your bank maintain perfect electronic records of the deposit, meaning the necessary documentation already exists automatically. You may also recall the widespread confusion regarding a proposed $600 reporting rule. A few years ago, during the legislative debate over the Build Back Better Act, there was a proposal to lower the reporting threshold for digital payment processors like Venmo, PayPal, and Zelle to $600. This proposal was strictly related to 1099-K tax reporting for digital business transactions, not cash deposits at commercial banks. Ultimately, that bill did not pass, and the final Inflation Reduction Act did not include those provisions. Consequently, the $10,000 threshold for cash deposits remains exactly where it has been since 1970. In fact, current legislative proposals, such as the Streamline Act introduced in late 2025, aim to increase the CTR threshold to $30,000 to adjust for decades of inflation. While that bill has not yet passed as of mid-2026, it demonstrates that the legislative trend is toward raising the limits, not lowering them. When you approach the bank teller window, remember that the staff is legally required to ask routine compliance questions regarding large transactions. Do not become defensive. Answer briefly, professionally, and honestly. State that you sold a car, received a family gift, or are consolidating accounts, and hand them your documentation. Do not volunteer unnecessary personal details, and absolutely never say anything along the lines of wanting to avoid a government report. Such remarks will be documented word for word in a suspicious activity report narrative. If a teller ever asks if you would prefer to break up the deposit, the answer must always be no. If you are ever contacted by a federal agency, such as FinCEN, the IRS, or the Department of Justice regarding your financial accounts, do not attempt to explain the situation yourself, do not sign any documents, and do not answer questions. State clearly that you wish to consult with your attorney. This is your constitutional right and the most prudent action you can take. Contact a qualified tax attorney or a criminal defense attorney with specific expertise in federal financial regulations before speaking further. In conclusion, remember this fundamental principle. The report itself is not the crime. The crime is attempting to evade the report. The $10,000 rule is an automated system designed to intercept illicit financial flows, not to entrap honest citizens. However, the software cannot distinguish between an illicit actor and a retired citizen who received misinformed advice. Protect yourself by depositing your funds completely in a single transaction, keeping impeccable records, and never splitting deposits. I highly recommend establishing a dedicated transaction records folder today. For every substantial deposit, preserve a brief note of the source, supporting legal documents, your bank statements, and any transfer confirmations. This simple habit takes 5 minutes but serves as an absolute defense. Thank you for your time. Please share this vital information with your loved ones, and feel free to share your own banking experiences in the comments below.